Good evening from Los Angeles. My name is Charlie Coker. I'm the Executive Director of Asia Society Southern California. Thank you for joining us for our program, COVID-19, the New Global Investment Outlook. To moderate this program, which is a program we held which is a follow-up to a program we held approximately a year ago at the outset of the COVID outbreak. Joining us again will be Jonathan Karp to moderate this panel discussion. Jonathan is the former Executive Director of Asia Society Southern California, as well as a former journalist with the Wall Street Journal and National Public Radio. So without further ado, I'll turn it over to Jonathan. Thank you.
Thank you, Charlie, and welcome to our audience in 27 or so countries. I think unless we got someone from Antarctica at the last minute, we had people on every continent but Antarctica. Another great program in Asia Society Southern California series on the impact of COVID. And as Charlie mentioned, it was almost exactly a year ago that we first looked at the economic fallout. And Howard Marks was with us for that show. So we welcome Howard back. Howard is the co-chairman of Oaktree Capital Management and a very well-known commentator on investing. And we also welcome Geraldine Buckingham, who is a senior advisor to BlackRock and the former head of BlackRock Asia. You can read her full bio on the website, but I'll mention a few other things. She was also a partner at McKinsey. She's also a doctor and a Rhodes Scholar. So there's no shortage of brain power today, and I want to thank you both. Howard, I would like to start with you since you're returning to us. It was a year ago that unemployment was 14.4%. There had been 30 million first-time unemployment filings. The stock market had begun its rebound from the March low, and it was only down about 15% from the historic peak in February. And you described that as a disconnect from the economic reality, which was clearly a global recession. So now the growth is resuming. The S&P is exuberant. It's up more than 60% in the past year and 8.5% this year. So are we also in a situation where there's a disconnect again?
I want to comment on the setting. You talked about last year, and you described it accurately. But you know, nobody has a crystal ball,
right? And
when we say what we think is going to happen in the future, we don't really mean this is what we think is going to happen in the future. What we say is this is what happened in the past, and we think it's going to repeat because, as Mark Twain said, history does not repeat, but it does rhyme. So, in other words, we think that the basic elements which are in place will be the same as in the past. You know, you put it in the context of the pandemic. At the very beginning of the pandemic, I read an article about a epidemiologist at Harvard named Lippisch, and Mark Lippisch, I think it was. And he said, we have facts, extrapolations from prior experience, and whatever he called the third thing, I call the third thing guessing. And of course, with the COVID, there were no facts, and there were very few modern day analogies to extrapolate from. So all we really had was guesses. Now, in the investment world, I had invested through three prior crises: 90, 91, 01, 02, 08, 09. And in each of those, we had a protracted decline, months, and we had a decline, a recovery, another decline, a slight recovery, another decline. So it goes down in steps. It doesn't go down in a straight line because at various junctures, a few people say, well, it's gotten cheap enough, I'm going to buy. So they buy for a while and it goes up, but then it resumes its downward. So here we were. The stock market made its high of about 3,300 on the S&P on February 19th. And in March 23rd, it was down a third at 2,200. But nobody thought it was over in a month. And so it just shows you the limitations of extrapolating from history. because that's all we could do. So here we are, a year later. Now unemployment's gone from 14 to 6, and we had the worst quarter in history in the second quarter for GDP, but of course the best quarter in history in the third. And as you say, the stock market's making new highs many days, and it did so on Monday. So where we are basically is that we have an elevated stock market when the economy is still somewhat depressed. Now, the bad news is that relative to today's rate of economic activity, stocks are quite high. The good news is that it's unusual to have stocks high when an economic recovery is just starting. Usually, the high of the stock market is kind of concurrent with the high of the economy, and eventually its economy gets tired and turns down, and the stock market follows, or vice versa. But there's leads and lags, but they move up and then they move down in tandem. Now here the stock market has moved up. Our hope is that the economy will move up and justify the level of the stock market. And since this current recovery probably will go on for some years, that once the economy catches up with the stock market and validates the level, that the two can go on together, going up in the future. So there's no science in this, and it's all a combination of historic patterns and gut feel. But I just find it very hard to be pessimistic about the stock market when the economic outlook is pretty good. Right. And when the Fed promises to be accommodative for years to come.
Exactly. Geraldine, to you, from your viewpoint in Beijing, BlackRock had, even before the IMF did so today, had sort of upgraded your outlook and said that the economic restart could actually even exceed market expectations. Mm-hmm. Are you as optimistic? What factors figure into your optimism?
Yeah, sure. Look, I would echo a lot of what Howard had to say. I think what's really important is that this is a crisis unlike other crises. This isn't about a drop in demand and with supply still being there and there being a mismatch. This is about both demand and supply very suddenly being turned off as the world went into lockdown. It's very different in its nature. And I think what we're seeing is, particularly as there's a lot of optimism, and there's always some question marks, and to Howard's point, it won't be linear, it'll go up and down, we'll see some variants emerge. But generally speaking, the vaccines have given people confidence that lockdowns and the sort of economic lockdown that occurred will be released. There's huge pent-up demand. We've seen enormous government stimulus into economies all around the world, particularly the US. I mean, with the most recent $1,400 stimulus checks that are part of Biden's latest bill, the estimate is there's going to be $1.6 trillion of pent-up savings with the US consumer. Now, people aren't sure, will people spend that? Will they save that? But when people are looking at the economy and seeing that kind of money on the sidelines that's itching to get back to work, people want to travel, people want to spend, they want to go out to restaurants. I think they see a lot of optimism, and markets often pull that forward. They say, we see rosier times ahead, we're going to pull that forward, and we see a lift at the moment. So I think what's really important is that the fundamental nature of this crisis is different. It's more akin to a natural disaster than sort of a classic recession where things turned off. And I think there's a lot of assumption now with vaccine that effectively things will turn back on. And you mentioned I'm in Beijing. It's interesting being in China. China's had a very different experience of this pandemic than many countries around the world. But certainly after the initial period of challenge, the Chinese economy has come back very strongly. And I mean, just an interesting fact, the first week of January was the busiest week at the Chinese box office ever. People have gone back to the movies. They want to spend money. They want to sit in a room with lots of people they don't know and watch movies. And I think if we see similar patterns of economic recovery play out around the world, now I think we know we won't, in terms of not all countries are going to have the same path here. And I think that's one of the critical things is developed versus emerging and all sorts of other inequalities we're going to see. But fundamentally, this is different to other economic challenges. Demand was turned off. People assume that as it turns back on, money will come back into the economy, we'll see growth, and that's why BlackRock, IMF, and others are saying we think there's going to be a very strong economic recovery.
And they point out, though, as you said, that the recovery is going to be very uneven, and
and that's both across countries and within countries. I mean, I know that when this started out, everyone said, will it be V-shaped, W-shaped, U-shaped, all sorts of alphabet being chosen. And I think the letter that has sadly emerged is K, that there are some who are doing pretty well and there are some who are doing quite poorly. And that will happen within economies, but it'll also happen across economies. And certainly in Asia, we're seeing North Asia versus Southeast Asia and parts of like India, Indonesia, et cetera, having very different trajectories as they look to come through COVID.
Right. And Howard, I want to talk about some of the positive drivers, just dig into it a little bit, the fiscal spending. How are you in terms of, how do you feel about the level of it based on historical measures? You wrote about this in your latest commentary a little bit. Why don't you talk about the two schools of thought on that? Because nominally it seems very high, but there are other ways of looking at it.
Well, and by the way, this is something else that made it impossible for anybody to anticipate the recovery that occurred both in the economy and the stock market, because clearly the Fed and the Treasury took the lessons they learned in the global financial crisis in months, and they put them to work in weeks or days, right, in a unique size. And they added on details like buying corporate bonds, which they'd never done before. In the past, the Fed injects bonds buys bonds when it wants to inject liquidity into the economy, but it's never bought corporate bonds before, or ETFs. ETFs probably didn't exist the last time we had a crisis. But a lot has been written about the inflationary aspects of injecting liquidity into an economy. And last year, the Fed expanded its balance sheet by $2.7 trillion. And the US, I think, probably ran a deficit of just over $4 trillion. So that's putting $7 trillion into the economy. And of course, the federal debt went up by 6 or 7 trillion. And we're going to do 4 or 5 trillion added to the economy this year, and some maybe lesser number in 2022. So that adds up to about 15 trillion. And the debt will go from 21 trillion to 35 trillion. And what does that mean? And the answer is nobody really knows. And the classic expectation is that kind of money printing and liquidity injection would be highly inflationary, because it would increase the demand for things, probably more than the supply, and it would give everybody inflationary fervor and inflationary expectations, and that this would lead to higher interest rates, which would eventually lead to lower security prices. So that's the normal point of view. The extreme opposite is modern monetary theory, which says for a country that is in control of its currency, that is to say, can print currency as it wishes, debts and deficits don't matter, because all you have to do is print more money. And the question is, can you print more money without affecting its value? That's really the ultimate question. And is there such a thing as printing so many dollars that people lose interest in the dollar, and that the dollar weakens, and in order to attract capital to the issuance of treasuries to fund the deficit, we have to pay higher interest rates, which increases the cost of servicing the national debt. And ultimately, do we lose the role of reserve currency to the world? And you would think maybe yes, but on the other hand, who are we going to lose it to? What can take the place of the dollar? Not many candidates. It's total morass. But I come down on the side of saying that it sounds too good to be true, that we can print all these dollars and run all these deficits and inject all this liquidity without having an impact. Now, you know, I don't know if I wouldn't say the size of the stimulus was questioned in 2020. Everybody knew we needed emergency bill. And by the way, even though I think that these actions will have some ramifications, they were absolutely right to do it. Because I think in your notes, Charlie, you said that last time I talked about global depression. And I think that as of March 18th last year, I was talking about global depression as a possibility. And then, of course, the Fed, Treasury and Fed came in and did what they did, and they knocked that out. Well, that's worth anything. And if you're talking about a global depression, you think back to the 30s, you would do anything to avoid a global depression. So the mere fact that something has possible negative ramifications doesn't mean you shouldn't do it. And in this case, it was absolutely essential. Now, you get to this year, and for example, the Biden package that was passed a week ago, 2 weeks. Larry Summers, who's of course a Democrat and a progressive, argued that it was too big, and that under Obama in the global financial crisis, I think they funded half of the output gap, and in this one they funded 3 times the gap. So if you take the two, that means that the ratio of the funding to the relief to the gap has increased 6 times. And Larry says it's just unnecessary. And here we have, New York. New York got a grant of $22 billion, and yet they're increasing the taxes on businesses and wealthy individuals. I would say at the behest of the left, because the left resents businesses and wealthy individuals. And it's just unnecessary. It's out of proportion, and it shouldn't be happening.
Geraldine, I think your BlackRock's research also had your most recent global outlook had a very interesting chart that showed what Howard's talking about, how the impact of the global financial crisis and the response, the fiscal and the monetary response compared to the pandemic. How do you see this view, though, of central banks that have essentially, not turned their back on inflation, but have minimized the inflation does not seem to be a concern for them in the near term or in the medium term?
Yeah, I mean, certainly the numbers I would have quoted are similar to Howard in terms of, the gap, the impact being a quarter of the financial crisis, the response being 4x. I mean, it really is quite staggering. I think what's interesting is that we've seen a fundamental shift in the position of the Fed, who've basically said we are not going to be as guided by inflation as we have historically. We are much more focused on markers like employment, and actually a little bit more of a sort of social cohesion message. Do you know what I mean? That actually we're solving for the sort of social good, and we're not going to watch inflation alone. I think that's a really fundamental shift. You've got central banks all around the world saying similar things, and even banks like the Central Bank of Australia, which had gotten through the financial crisis holding rates at 3 to 4%, is now hovering around 0. So I think this is a very, very fundamental shift. And as I said, this sort of social cohesion message is really coming through from the Fed. I absolutely agree with Howard that like a year ago, it was the right thing to do. And I think it's been very well demonstrated that the sort of timeline of this downturn has been significantly shortened by the magnitude of money that's been put to work. Exactly as Howard said, all economists would have told you this will lead to inflation. But I think what's interesting is that there's been a little bit of a sort of in the air with the Fed, even pre the pandemic, around should we be using inflation as the sole marker the way we do? I mean, there are many, many trends that COVID has not so much created, but accelerated. And I think this move of central banks away from sort of just fidelity to inflation, I think actually was sort of coming, and the pandemic has really accelerated it. And they're now looking at a broader range of markers. I mean, it's an interesting thing that you've got the Central Bank of China behaving quite differently. China has not put anywhere near as much money to work. Now, as I said earlier, their pandemic experience has been different, just in terms of the magnitude of the health crisis that happened in China appears to be less than it has been in other countries. But the Chinese central bank has put much less money into the economy and really continued its sort of long-term path, where they are looking not just for economic growth, but they're very focused on quality growth. They want growth to be less polluting. They want growth to be more equal, and they want it to be less funded by bad debt. And I think they've had sort of for a long time this kind of, we're trying to grow enough to maintain social cohesion. And in a funny kind of way, now you've got the Fed a little bit saying something similar. So I think that the Fed has taken a fundamentally different stance. Other large central banks around the world are following that message, but we are seeing differences in significant economies like China, just given their context is quite different, both politically, socially, and as I said, on a health basis.
Right, and China was the one major economy that did not end in recession last year. It grew at 2.3% because of that.
They still took an awfully big hit.
Yeah,
yeah, very big hit because of their high growth. But
Charlie, if I may add one thing, when you think about this idea that debts and deficits don't matter for a country that can print its money, it's kind of like thinking about giving your brother-in-law a credit card, which has an infinite limit and never have to make a payment. Mm-hmm. And I think you would get some bad behavior. And that's what and modern monetary theory, I may be exaggerating, but that's the way it's been taken into Washington. That's what they take it to say.
I'm interested, Howard, about your brother-in-law, but that's the family member you picked.
Howard, how about obviously inflation is a major risk out there at some point. Interest rates have been getting a lot of attention because of some recent spikes. Again, it's all pretty relative. But how are you feeling about inflation rates and how people should be thinking about the movements that they're seeing?
Well, look, I first of all, let me say, I don't know anything about inflation, and almost nobody knows anything about inflation.
Interest rates.
Because, there was this thing called the Phillips curve, and for 50 or 60 years, people took it to explain the behavior of inflation, and they said that inflation is inversely correlated with employment, and when employment goes up, that is to say, unemployment goes down, then inflation goes up because the slack goes out of the economy and labor can demand greater compensation. So unemployment rate down, inflation up. We had 12 years after the global financial crisis. We had high debts, and we had high deficits, and we had low unemployment. We got down to the lowest rate in 50 years, and we still never had any inflation. The Japanese and the Europeans have been trying to get 2% inflation for years and years, and they can't get it. So I would say that inflation is mysterious and unpredictable. And I, unlike Geraldine, lived through the 70s. I was in business in the 70s, and it was a terrible period because we had inflation in the United States for 10 years at a high rate, and we couldn't stop it. Nobody could figure out how to stop it. The chief economists for Salomon Brothers and First Boston were nicknamed Dr. Gloom and Dr. Doom, and all they did was go around saying, we don't know how to get it down. So that's my preface, because I want to say that I really don't know. But the general assumption would be that we're going to get some inflation, and it's gonna, the Fed has always said they're okay with it going to 2.5 once in a while, or maybe 3, as long as it doesn't average too high. But hell, we may get 3, we may get 4. Nobody thinks we'll get much more than that. It's first of all, it's hard to see labor putting the squeeze on as it did in the 70s, because the unions are weak now. The unions in the industrial sector are quite weak, and I don't think people have the cost of living, automatic cost of living adjustments that they did then, which perpetuated and reinforced the inflation. And the Fed certainly, if you can take them at face value, the Fed certainly says we're not worried about inflation. We're worried about a weak economy. We're worried about job creation. Now, of course, they always want to poo-poo inflation because they don't want to encourage inflationary expectations, which can become embedded and self-reinforcing. But the Fed, which should know more about it than I do, says they're not worried about inflation. They're worried about job creation, and if inflation comes, they say we have tools to deal with that.
And interest rates, though, that's the biggest thing looming out there.
Yeah. Well, look, if we get last year, or let's say at the beginning of this year, we had a 1% return on the 10-year, the Treasury 10-year, it was 0.92 yield, and we probably had 1.5% inflation. So if you bought the 10-year at a yield of 0.9, you had a negative return in real terms, in purchasing power terms, of 0.7, 0.6. People aren't going to buy treasuries at negative yields forever, and so if your purchasing power is going down 2.5 or 3% a year, you would think that you would want 4 or 5 on a 10-year treasury, and certainly that's been the normal relationship in the past. But if the 10-year treasury, which today yields 1.6, has to yield 5, the yield has to go up 340 basis points, and something called the duration is probably, I don't know, 6 years, let's say. So you multiply the needed change in points times the needed change in yield over the duration. That would take several points off the price of the 10-year, and on longer bonds it's worse.
Right, but people shouldn't be alarmed by the. I mean, the market seemed to jump when the 10-year went to 1.7 or 1.8.
Yeah.
But,
well, it shouldn't come as a shock. I mean, most people feel that interest rates are artificially low, yeah. And can the Fed really keep them artificially? The slogan has been lower for longer, and the Fed has said they're going to keep rates low. I think they've said at least through the end of 23, which is almost 3 years from now. But can they keep interest rates artificially low if they're not commensurate with inflation? Seems hard.
Yep.
If the dollar is losing 3% of its value every year, is China going to buy our treasuries at a yield of 1 or 2? Doesn't seem right. Of course, then they have to figure out where they're going to put their money, whether it's going to be Bitcoin or what. But
their own cryptocurrency.
Yeah, right. But yeah. So I think that, look, anything can happen. I think that the center of the distribution of possibilities is inflation of 3 to 4 and a 10-year treasury of 4 to 5. And, everything goes down a little bit in value when interest rates go up.
Right. Geraldine, you mentioned that China's central bank is not flooding the market. And obviously, China's recovery and America's recovery are going to be critical to the overall economic picture and for investors, how markets are going to react. What are you seeing in terms of how the Biden administration and China, what relations will look like coming out of Trump and the trade turbulence? Is that does BlackRock have a view on how relations are going to proceed?
Yeah, sure. I mean, as Howard says, no one has a crystal ball. But I think it's fair to say that the challenges between the US and China are persistent and structural. I think we're going to see a lot less fireworks. A lot less of it's going to be done via Twitter. But I think it's clear that the broad position of the US administration in regards to China is not going to change significantly. There's going to continue to be pressure, sort of a real strategic reckoning between these two countries, particularly around areas like technology. And the sort of creation of sort of two technology stacks around the world as both are sort of vying to be not just superior, but also independent. I think that's the other critical thing. Both have seen weaknesses or vulnerabilities that they might have depending too much on the other from a supply chain point of view around technology, etc. So I don't think we're going to see a major shift. I do think we're going to see pockets of cooperation. I think the big one is climate change. And it's interesting that with the Biden administration's climate change meeting that they want to have in a couple of weeks, they did invite China to that discussion. And there's obviously been conversations between the US and China administration already on climate change. So I think we're going to see areas of cooperation, but I don't think we're going to see a significant shift in the challenges and the direction of the relationship. From a trade point of view, I think we may over time see some softening. But as I said, I think these challenges really are persistent. I don't think they're dependent on the administration. I think they're more structural than that. And we're going to continue to see these two countries sort of butting up against one another as they both look to sort of become a dominant, the US obviously is, but sort of a dominant power center in the world.
Right. And that relationship is obviously very important to investors around the world. Howard, the IMF meetings this week give an opportunity for also the Western countries to sort of showcase whatever cooperation and collaboration they're going to have moving into this restart. And a year ago when we spoke, as you pointed out, America had absented itself from global leadership. How do you assess America's role and kind of the coordinated efforts of the advanced economies a year later?
Well, as far as I know, it's no secret. I think that Biden wants to, Trump was, essentially isolationist. And I think Biden wants to redress that. I think he wants to restore our friendships and our alliances around the world and the spirit of cooperation and mutual defense, and not badmouth, all of our alliances. And I think he'll certainly do that with NATO. I think he'll be a nice neighbor to Mexico and Canada, and I think he's already reached out to Asia to try to come together as a bulwark against China. So I think we'll have a much more internationalist administration.
And will that impact markets positively?
Well, it'll impact markets positively in the sense that it'll remove the crisis environment. What's the probability of military conflict with China? You can't say it's zero. Whatever it was, I think it was much higher in the last 4 years than in the next 4, because I don't think that Biden will be as confrontational, but I think he will be more forceful than Obama or Bush. This problem of China's behavior has been a long-running one, and nobody's ever done anything about it. And the truth is, until Trump, nobody even said a word. And Trump elevated it. Of course, it was complicated with the Trump, because Trump, for example, viewed negative balance of trade as a problem, as a deficiency. He would say they're beating the hell out of us. But of course, I always say that if I go to the barber and I get a haircut and I give him $10, I have a negative balance of trade. But I didn't get taken advantage of. I got the haircut. So, but Trump viewed things simplistically, and he viewed trade as a negative, and globalization as a negative. And the world has benefited greatly from globalization, and 90% of Americans have benefited greatly from globalization, because we buy products that are made cheaply in the rest of the world, and for a long time it was mainly China, that we couldn't make here, or we would make very expensively here. So I think that the better tied together the world is, much better for business in general and for investors.
Geraldine, does the post-pandemic globalized economy investment environment look different than the pre-pandemic environment and attitude?
Well, I don't know if this answers your question directly, but one thing I did want to add, I do think that China is going to be, and we're already seeing it, one of the areas that investors globally are looking to deploy money in really big ways. That's partly because the world is underinvested in China. China now represents something like 10% of global equity markets, 15% of global bond markets, and yet onshore foreign ownership is still in the low single digits. And so when you look at just the pattern of growth around the world, and particularly post-pandemic growth, where China is taking a bigger slice of the pie at the moment, global investors are under-allocated to China. We're also seeing that Chinese rates, as we were saying earlier, have held more. So, you can get more of a yield in Chinese government fixed income than you can in many other parts of the world. And you're also seeing relatively low correlation between China and developed economies. So for all of these reasons, investing in China is something that global investors are looking to do. And I should actually say, the other thing is, of course, in the last few years, we've seen Chinese securities included in major global indices in much larger proportion, both on the equity and fixed income side. So all of these things mean there's going to be a lot of money. There is a lot of money, and there'll be more money flowing into China. And one of the sort of ironies of that is that for years, the Chinese government's been worried about currency outflows and doing things to try and, you know, ensure that that's minimized. And actually now that has really flipped, and there's, you know, the international money is flowing into China. FDI is very high. Right. And I think that's going to continue, and certainly is one of the opportunities for investors around the world that investors should be, and many are looking to capitalize on. I think another big shift that I would highlight that we haven't spoken about yet is the real growth and increase in attention to sustainability. Again, this is another trend that I'd say was there pre-pandemic, but the pandemic has actually accelerated it. I think partly because the world, I think it's a few things. One is that coincident to all of this, I think the world's focus on climate change has really increased, whether it's sort of natural disasters around the world, you know, multiple governments, including China, as well as many, many Western governments making net zero commitments, whether it's 2050 or 2060. So there's a huge focus on environment. I think the pandemic has increased focus on the S in ESG, and, you know, how companies are treating their employees, how people are looking after each other. And then I think, quite frankly, sustainable investments have been shown to either hold their ground or actually outperform through these periods of market volatility. I think you saw 51 of 58 sustainable MSCI indices outperform their traditional counterpart through the market turbulence of 2020, and investors are putting more money to work in sustainability. So I think that's another absolutely critical trend that, as I said, was there before the pandemic, but has accelerated through it. And I think we're going to see play a much bigger role in portfolio construction than we did pre-pandemic.
Wow. Okay. Well, you took care of like the next three questions.
Oh, sorry.
No, it's great. No, it's fine, because obviously I think a lot of the people listening want the sort of the macro analysis, but exactly what you just said. Why, you know, I mean, why China makes sense to invest in, and what sectors. Howard, I'd just like to get you to comment on that. You know, what are you seeing, you know, as you always say, that the opportunities are where people aren't looking. Where should people be looking, either regionally in the world or in terms of industry sectors or companies?
The U.S. historically has always had the best investment outlook, but U.S. securities have generally been more expensive, commensurate with that. So the U.S. has not been a bargain. But has done very well. I absolutely agree with Geraldine about the investment in China in particular. I have for charity, I use something called donor advised fund, and I was on the phone today with my we used to call it stockbroker, now it's probably called a financial advisor or something like that. And I've been talking about moving money into China, and she said, well, we'd have to get a modification of your account because your account is limited to 2% in emerging markets. So I think that's really nutty, because, you know, China is what, 3/4 our size, Geraldine, something like that, in the economy. Yep. So why would it be right? How could it be right to have 90? Well, you could probably have 75% of your money in the U.S. and 2% in China. Just doesn't scale. And, you know, especially institutional investors, you know, people too, I guess, say, oh, you know, yes, we're investing in China. I have 2%. We're investing in the emerging markets. I have 3%. It's not enough. You know, if China does great, it's not going to move the needle. And you know, one of the things that holds people back, especially institutions, is a lot of institutions, kind of their mantra, whether it's conscious or not, is I would never do so much of something that if it didn't work, it would give me a problem. I'd never do so much that if it didn't work, I'd lose a lot of money. Well, that's fine, except that then you have to acknowledge that you'll never do so much that if it works out well, it'll move the needle. 2% in China is pretty close to zero. And if China is going to be an important figure in the world, you know, not too long from now, it'll be the world's biggest economy, you need much more than 2%.
No, absolutely. And, you know, emerging markets in general, and in Asian emerging markets seem to be a bright spot for growth, according to the IMF and for a lot of other people. we see that opportunity. Geraldine, a question from one of our registrants that he wonders, given the interest and the flows in China now and the interest, what's the risk of a bubble there, and what is the risk to foreign investors that there would be capital controls at some point that affect foreign investors?
Sure. I mean, look, I think we're a long way from a bubble. Do you know what I mean? As both Howard and I were just saying, at a global level, institutions and individuals are woefully underinvested in China. Do you know what I mean? So I think to get a bubble, we just need a lot more air in the balloon. Do you know what I mean? I think the deployment is still relatively de minimis. I do think the question touches on, though, something that is important, which is investor confidence in putting money into China. And, governance, regulatory framework, et cetera, around how is this going to operate so that investors can have confidence that they can move money in, move money out, that there are going to be the appropriate regulatory controls, so I'm not sure if the name Luckin Coffee means something to many of the people listening here, but, that was a very prominent example earlier this year of basically massive accounting fraud. And it was a company that, many Western investors had invested in. Now, I'd say to you, look, that's bad, but we have accounting fraud happen in other countries around the world as well, whether it's Enron or, the name escapes me, that company in Germany a couple of years back. I mean, we have accounting fraud around, but the point is that the Chinese regulatory framework needs to give investors confidence that they will get transparency, they will get the appropriate insights. And what I would say is, I don't think we're there yet, but I do think there is significant movement. And, whether it's the sort of CSRC becoming more transparent in the filings they expect companies, the rigor with which these things are being checked, I think we are seeing movement in the Chinese regulatory framework towards what we would consider a more global standard. But there is still a gap and there is still work to do. And certainly, I think when you have events like the Ant IPO earlier this year that got pulled at the last moment, and there's plenty of theories as to what happened there, and there's no doubt there was a lot of politics swirling around that one. I think those sorts of things, they give investors confidence on the one hand that something wasn't allowed to go to market when there could be a problem, but it also makes investors nervous. If that can happen with the biggest IPO, one of the biggest IPOs in history, then what's going on in this investing market? And I think the message fundamentally is that there needs to continue to be reform in China. And I think the central bank is very focused on that can give global investors confidence that they can invest in China as they would in other markets like the US, where you're not guaranteed that bad things won't happen, but you can have more confidence that they won't.
Right. And the only thing I would add to that is that the essential ingredient for that process to take place is time. They can't, there's nothing they can do to reassure us tomorrow of the rule of law. You have to see it in operation over a period of time, including some tough spots.
And so the flip side of that question comes from former chairman of Asia Society Southern California, who, for either of you or both of you, can you imagine that the US government or the Treasury would prohibit or restrict investors trying to invest in China because of either national security concerns or other geopolitical concerns?
I can imagine almost anything, and I can certainly imagine that. I mean, we've already administrations have stepped in and said no to certain transactions in the recent years, and I could see some of that.
Yeah, I think what you describe is sort of the extreme scenario, but we certainly have had flavors of that in the past administration where there's been a political push and, certainly around, if not restricting general investment, things like the federal retirement fund, and that not investing in Chinese securities. We obviously could have sanctions, whether it's on individuals or companies or those sorts of things that would make investing harder. I think actually an outright ban on investing in China feels to me very extreme and unlikely. But look, whenever you have the sort of geopolitical environment, that we have between these two countries, I think that's unlikely. But to Howard's point, it's impossible to say anything's impossible.
Right. And actually, something occurred to me because obviously, the situation with the Uyghurs, it creates a challenge for American policy and for relations. But given that, you mentioned the ESG thrust of investment, and in general, even though the specific criteria and parameters for that kind of investment might be, for company, but in general, it's considered socially responsible investing, and it kind of has this aura of a greater sort of social awareness. Might that impact ESG investment in Chinese companies because of political concerns?
Absolutely. I mean, I think there's no doubt that it will. I mean, it's interesting that a couple of things. Firstly, it's not just Chinese companies. I mean, we've seen in the last couple of weeks, H&M, ASSC, Gap, all sorts of Western companies that are getting into hot water around where exactly do their supply chains run. Do you know what I mean? So I don't think it's just going to be an issue for Chinese companies. Certainly, the Chinese regulator is actually, from an Asia point of view, one of the regulators that's moving most quickly around ESG disclosure. That's broadly across ES and G, and they've been more focused actually on E and G. As I said, environment is a big government. I mean, when any 5-year plan you look at for the Chinese government, the last 15 years, environment's a big push, and governance is viewed as important to build investor confidence. I think it is getting focused. It will get more focused. The particular issue around the Uyghurs is obviously a very political one, and so I think that gets a little bit more complicated. But there's no doubt that as investors are looking to put money to work with a greater ESG awareness, there will be new questions asked about Chinese companies, as there will all over the world, and that will be just one of the areas where investors will be looking for transparency.
Right,
and it's also on investment managers like BlackRock and others to help provide investors with the information so that they can understand, they can get greater insight into where their money is going.
Exactly, and on the transparency point, another question from a viewer going back to the Ant IPO. As you mentioned, there are a lot of theories about why that was pulled. I mean, the public theory is that there were regulatory issues and they wanted to restructure the company, which is going to happen, whether that was the reason or not. But do you believe, the question goes, do you believe that this is a one-off event because of Jack Ma, meant to sort of punish Jack Ma? Or is it a more general warning to billionaires, Chinese billionaires and entrepreneurs, that there might be a shift, or that they should be careful?
I mean, personally, I would say I don't think there's a single reason. Do you know what I mean? I think it's a multifactorial answer, but I do think undoubtedly that part of it was the Chinese government that there were regulatory questions. But as I said, I don't think that was the only factor.
Is there a broader message, though, do you think?
I think certainly that would have been, obviously that was noticed broadly, yeah. And whether it's regulatory concerns or the other messages that may have been part of that, I think that it was broadly recognised that there was a lot going on there. But I do actually think genuine regulatory concerns were part of it.
Howard, with asset prices in the stock market very high and people looking for alternative investments, how has your thinking on alternative investments changed? I mean, you recently talked about your year-long conversation with your son, who's an investor, and I believe you've changed your view somewhat on Bitcoin. How should people think about cryptocurrencies?
Yeah, what I described was, of course, spending months with my son and his family, and a lot of active discussion on a lot of investment topics, including Bitcoin. And I think the upshot is that when Bitcoin and other cryptocurrencies became popular in 2017, I came out against them because out of traditional skepticism and traditional leeriness of financial innovation, and finally because of the fact that something like a cryptocurrency has no intrinsic value, doesn't produce a cash flow, and has no backing, and so shouldn't be touched. But he was able to convince me that there are lots of assets that have no backing and don't produce cash flow and are very valuable. They're paintings, diamonds, to name two, a barrel of oil, gold. All these things have no intrinsic value because they don't produce cash flow, but still they're valued. And so what that leads you to is what's called what I would call the supply and demand case. And in the case of Bitcoin, apparently the software limits Bitcoin to 21.5 million Bitcoin, but in the partisans' opinion, the demand is unlimited, and it's kind of, they think it's like gold but better, because you don't have to store it expensively, or it's not hard to move, and it's not hard to send, and so forth. So they think it's better than gold, and they talk about replacing gold, and what would happen if the Bitcoin of the world had to replace half the gold. What would that do to the price, and so forth. So the point is that there's and that it's growing in its use in third world nations where people don't trust the banks, or can't get to the banks, or don't trust the government, and it's anonymous and confidential, and so forth. It has all these advantages. So I don't have a conclusion yet, and I don't know if I'll ever know enough to have a conclusion. But I know now that in 2017 I didn't know enough to have the strongly negative reaction I did, and it was knee-jerk skepticism, which I'm trying now to get away from. All my career, I've been skeptical of excesses, skeptical of financial innovation, mostly right, very cautious, fitting my career in fixed income. Because if you're a debt investor, there's no upside, there's only downside if they don't pay. So it's really caution that pays off in fixed income. But when you get away from fixed income, to things like equities and distressed debt, private equity, real estate, et cetera, avoiding the losers is not enough. You also have to find some winners. You have to imagine some positive outcomes, not just the negative ones you're trying to escape.
I think the other thing, just to add there, sorry, Jonathan, if I could, is that I think, and obviously Bitcoin's a slightly more extreme example of it, but traditional asset allocation is really struggling.
Yeah.
Government bonds can no longer play the role in a portfolio that they were, and people are really looking for yield. And while Bitcoin might be a little bit more out there on the spectrum, I think it does demonstrate the fact that if people want to generate some sort of return, they're having to put money to work in places they haven't traditionally, and asset allocations become a lot more complicated. Yes,
well, let me add to that. That the vast majority of my clients are institutions, pension funds, and endowments, and the average pension fund or endowment needs a return of about 7% a year to make the math work. Basically, 5% spending for an endowment, 2% for inflation. You need 7, and nobody thinks you can get 7 from stocks and bonds today. So exactly. So it's inescapable that you have to go into alternatives to have a chance of making 7. How many 1% government bonds can you buy and still hope to make 7?
Exactly.
Right. And on that, you noted that Howard, you noted that the sharp recovery of the markets last year sort of deprived people of a real buying opportunity because it recovered so quickly. And as you point out, you are mainly in the debt world, and you launched this distressed debt fund. Has that also been the case for distressed assets, that they disappeared as quickly as stock value?
Very much so, because number one, the Fed indicated its intention to keep companies afloat. The airlines would have all gone bankrupt, and they gave them $50 billion and kept them going, and so forth. Historically, we've made a lot of money buying in those 3 crises I described, because the people who owned assets, number one, if they owned them on leverage, like Archegos you read about, if you own it on leverage and things go bad, you can really have a meltdown, in which case an opportunistic buyer can score a lot of bargains. Or if the bad news is unabated for a few months, the asset holders, lose heart and want to sell at discounted prices. And psychology's weak, and the buyers recede, and nobody steps forward. And so the few people who will buy from the motivated sellers get good bargains. But none of that happened after March of last year. That the Treasury and the Fed put an end to that, and nobody was pessimistic. Nobody's existence was threatened. So the distress investor or the opportunistic investor in general had very few opportunities.
Right. Well, we're almost out of time. I would like to thank you both for sort of, going around the world, looking at the investment landscape, pointing out the fallacies, pointing out the things that people should be looking for and caring about. It's been very valuable. And I hope that in a year from now, we can have you back and see how things pan out.
Thank you for your excellent questioning.
All right.
Thank you, Geraldine.
Thank you. Thanks, Howard. Good to see you. Thanks both.
And I'll turn it back to Charlie Coker. Thank you.
Jonathan, Howard, and Geraldine, thanks so much for an amazing discussion, an insightful discussion, and very much look forward to revisiting this issue a year from now, where hopefully we'll be in a much better and a very different place. So again, I'd like to thank our promotional partners, AmCham Shanghai, Asian Business League of Southern California, USC Marshall School of Business IBR MBA program, and Cal Asian Chamber of Commerce for their support. I hope that you will join us for our next program, which will be featuring HBO Max and championing representation in the entertainment industry, which will be on April 14th at 5 p.m. Pacific time. So on that, I will also ask people if they would be so kind as to consider becoming a member or donating. We make these programs available for free, and please support us so we can continue to make this programming available. So on that note, thank you everyone, and have a wonderful evening or wonderful morning, wherever you are. Bye-bye.